James, we had that PPI reading coming out just a short while ago, 7.7% rise last month, and that's much better than the market expected because they were looking for a figure north of 8%, so another inflation surprise.
Hi, Stephen. Yeah, it just contributes to the trend at the moment of inflation figures coming down. One thing to bear in mind on the PPI number is there was a large sort of technical increase in the previous month attributed to fuel and administered prices. So on a month-on-month basis, sure, it's come down from 4% to 1.3%. But it's just adding to the momentum. More importantly was the CPI number we saw yesterday, really, with regards to interest rate policy.
And of course, that CPI figure coming in at 3.7% for July. The market was looking for a figure of around 4%. What's the market now starting to price in ahead of the MPC, which takes place in just 2 weeks' time?
Well, as a response to the 3.7 print, as you say, the market really has gone forward and started to discount almost the foregone conclusion of a 50 basis point cut at next month's MPC, and even starting now to look for further cuts, as you would expect it to do. If we get a cut, obviously the next move would possibly be in a similar direction and not up for a long time. But with that psychologically coming in below 4% here at Nedbank, we're predicting, or at least forecasting, that inflation on the CPI level remains below 4% and ends the year just at 4.2%. So with regards to monetary policy, that does send a strong signal, I think.
Are there any risks to that inflation outlook of yours in the short term there? Because of course we do have these strikes at the moment. We have very high wage demands. We've had those electricity price increases, and the second round and third round effects of those are going to feed through to inflation at some point.
That's it. Well, as pointed out at the MPC, the real risks to the inflation outlook, as you say, administered prices, which we're seeing come through now, are not really balancing the deflation or the drop in inflationary areas in the CPI figure. So more importantly is the wage demands, and current topics at the moment, and is certainly the strikes. So we have yet to see how the MPC deals with those and what the outcome is. We're not seeing any sort of meeting of minds or agreement on those strikes. So, I think those are the real risks. They could possibly lead to weaker currency, but at the moment, with all the foreign portfolio inflows we're seeing, as soon as the currency gets up to weaker levels around 740, we're seeing it come straight back, and now touching on 730 at the moment. So those risks, you must think at the moment, are going to be less than they appeared last month, given the drop we've seen.
Well, coming on top of those soggy growth figures that we saw for the second quarter out earlier this week, and we've also had the Reserve Bank Governor Jill Marcus on a number of occasions alluding to the risks that still lie with Europe. Those risks are building at this stage. Growth isn't quite as good as it was earlier, so quite a few factors have changed since the last MPC, haven't they?
That's it. This week we've seen a downgrade, Standard & Poor's downgrading Ireland over concerns of the fiscal ability to prop up the financial sector there. We've also seen Greece coming back in with Greek levels, Greek trading over their German bonds, reaching levels just where they were sort of prior to the IMF bailout package we saw earlier this year. So that's a concern. With regards to the Eurozone, it's still there. It is a big concern. The only real economy that's performing there on the industrial side is Germany, with still strong industrial domestic growth figures and those export figures. But those aren't going to be maintained, you must think, with the rest of Europe really in a bad situation. And that their major source or place that they do export to is Europe and China. And China also, we know, slowing down their economic activity as well. So their demand will slow. So it isn't a great picture either, no. So that will be something that will be considered, as you say, at the MPC.
You said that the franc moving down ahead of that anticipation of an interest rate cut next month. How about the longer end of the curve? Because when we spoke last week, there had been huge interest in South African bonds. Have we seen that sustained through to this week? Is that dying down a bit?
Been a bit of a reversal on the longer end of the curve, that's right. A steepening, so to speak, between the 157 and 186 bond, which is sort of 5 versus 15-year area. That's moved up 10 basis points-ish on today's trading, which sort of goes in line with the move in the short end. You'd expect a steepening. We've seen appetite in the swap market, 2v10 area as well. it's been the trade of the last few weeks, so yeah, we're seeing some profit taking there, and also some that's the sort of shape you would expect with the anticipation increasing for an interest rate cut.
How about the currency market? You mentioned moving from 740, which hit on Tuesday, 742 in fact I think, down to around 730. Are we seeing much action in the currency market? Is it pretty inactive at the moment?
Surprisingly slow today, yeah. We've seen a really narrow range, 730 to 734. Yeah, there's very little to add. There's not been a lot of activity there, so we'd expect the range probably to be around 728.38 today, longer term 720 to 750. But yeah, at the moment a really inactive day on the rand market.
And of course, we saw some pretty poor economic data out of the US yesterday, that helping the dollar to weaken a little bit. We have some negative news here at home as well. We have that strike action building. There have been demonstrations in the city centre this morning. COSATU now calling for lots of solidarity strikes. Is this being viewed at all by the international markets as a concern?
It's got to be a concern in some way. We've had some comfort from the finance minister saying that the strikes at the moment will not affect the economy. So I think the market is, as you can see reflected in the rand price, is happy with the position at the moment. But it certainly is in the headlines, and it is something to keep a close look on. As you say, with regards to the US numbers we've seen, it's just also confirming that the pickup in the economy over that side isn't occurring. We've seen new home sales and existing home sales disappointing, as well as durable goods sales disappointing as well. So the consumer that side looking to reduce his debt burden and not put things on credit. So that's another indicator that all's not well at the moment perhaps in the world economy, and it's not picking up as we'd hope.